Leaders from every level of Canadian government are lashing out at Stellantis today. The automaker says it's reneging on plans to make Jeeps in Brampton, Ontario, and moving production to the U.S. instead.
A surprising shift is unfolding in North America's auto industry, one that's raising more questions than answers. A decision meant to boost America's competitiveness may actually backfire. Not long ago, Stellantis, the parent company of Jeep, made an unexpected move. It announced it would relocate production of the Jeep Compass from its Brampton, Ontario plant to a facility in Belvidere, Illinois. Stellantis is transferring production across the border, and understandably, many Canadians are frustrated. "We're not going to just sit back and say that's okay, because it's not," said one official, pointing to the company's previous commitments to the Brampton facility. The plant was temporarily closed in 2023, putting 3,000 workers out of jobs. At first glance, this might look like a win for the US and a setback for Canada. But take a closer look, and the picture becomes far more complex. Stellantis appears to be making a calculated move to avoid the 25% import tariff introduced by former President Trump by shifting production to American soil. The move also aligns with the company's broader plan to invest $13 billion over 4 years in US operations and hire around 5,000 new workers. Yet, the market didn't celebrate. In fact, Stellantis shares dropped sharply after just one trading session. Analysts quickly pointed to the rising costs of US labor, expensive energy, and strict Buy American rules, warning that these factors could outweigh any benefits the company hoped to gain. Meanwhile, in Canada, the government's reaction was swift, but strategic. Prime Minister Mark Carney and Ontario Premier Doug Ford refrained from escalating the situation. Instead, they made it clear they were still in control. A letter obtained by CTV News, sent by Foreign Affairs Minister Melanie Joly to Stellantis' president, reminded the company of its previous commitments. Under its agreement with the Canadian and Ontario governments, Stellantis pledged to maintain its full Canadian footprint, including Brampton, in exchange for substantial financial support. The letter was clear. Failing to meet that commitment would be considered a default under the agreement. "We will hold the company accountable," officials said. Both Carney and Ford emphasized that Stellantis can't simply back out. The automaker is still bound by legally enforceable commitments tied to jobs and investments. Behind the scenes, Ottawa quietly activated protective clauses in its agreement with Stellantis, making any attempt to withdraw from Canada potentially very expensive. So a new question began to emerge. Is this a painful loss for Canada? Or is Stellantis digging itself into a hole? For many Canadian workers, the uncertainty is deeply personal. There are 3,000 employees at the Brampton plant and over 1,000 more in the supplier network that supports it. Stellantis, which owns brands like Jeep, Dodge, Chrysler, and Fiat, reported that the US tariffs have already cost the company $480 million Canadian dollars. But that was just the beginning. The real impact came when the new US trade policy kicked in. On April 3, 2025, Trump's 25% tariff on all vehicles and light trucks made outside the US officially went into effect, sending shockwaves through the global auto industry. Overnight, supply chains that Stellantis spent years building were disrupted. Parts from Europe, components routed through Mexico and Canada, everything became more costly, slower, and mired in bureaucracy. By the end of the second quarter, Stellantis had racked up approximately $300 million in unexpected costs. It closed the first half of the year with a net loss of about $2.3 billion, with some estimates pushing that number closer to $2.68 billion. Analysts at Jefferies warned that, if trends continued, losses before interest and taxes, EBIT, could exceed $7 billion by the end of the year. Several US plants in Michigan and Indiana were forced into temporary shutdowns. Production of 2 Jeep models in Mexico was halted entirely. Around 900 US workers were laid off or placed on standby, waiting for a policy fix that never came. Trump called it a win for American workers. But the financial reports painted a very different picture, one in which protectionist policies were causing more harm than good. Meanwhile, Canada responded not just with words, but with decisive action. While Washington claimed a political victory, Ottawa turned the situation to its own advantage. Foreign Affairs Minister Melanie Joly reminded Stellantis of the 2022 Electric Vehicle Investment Agreement. Any cut to Canadian production or jobs could trigger penalties under that deal. Canadian federal agencies began exploring whether the company's actions could be legally classified as a breach, opening the door for compensation, or even forcing Stellantis to move more production to Brampton. Premier Doug Ford backed this approach, urging Ottawa to stay firm. In response, the federal government formally activated protection clauses in its EV agreement. As a result, Stellantis was required to maintain its component manufacturing in Canada. The company couldn't simply walk away. It was now bound, not by political posturing, but by the intricate, contractually enforced value chains Canada had strategically developed years ago. While Brampton faced a cloud of uncertainty, the city of Windsor offered a silver lining. Rather than crumbling under pressure, Windsor adapted. To offset the loss of Jeep production, Stellantis added a third shift at its Windsor assembly plant, preserving production levels and protecting hundreds of jobs. At the same time, Ontario expanded its workforce retraining programs, transitioning more than 2,000 Brampton workers into the Next Star EV battery project, a nearly $5 billion Canadian dollar joint venture between Stellantis and LG Energy Solution. Once fully operational, Next Star Energy is expected to create about 2,500 high-paying jobs in Windsor, positioning the city as a cornerstone of North America's electric vehicle future. At the same time, Unifor successfully negotiated extensions to both federal and provincial labor support programs through 2027, providing long-term stability for workers. In just 6 months, Ontario not only weathered the initial shock, it turned it into momentum. What first appeared to be a major setback instead became the launchpad for a new industrial era, one defined by adaptability, not fear. While Canada regained its footing, Illinois was forced to confront a tougher reality. For Stellantis, coming home to America proved far more costly than remaining in Canada. The cost savings the company had hoped for disappeared quickly. Wages in Illinois were 25 to 30% higher than in Ontario, and energy prices spiked nearly 40% after U.S. federal subsidies were withdrawn in 2025. On top of that, strict Buy American regulations required Stellantis to overhaul its supply chains to rely solely on domestic components. This caused major logistical bottlenecks and delivery delays. Productivity dropped significantly, with some U.S. plants running at barely half their capacity. Thousands of unfinished vehicles ended up sitting idle under tarps in storage yards. Restructuring expenses and depreciation added another $3.3 billion US dollars to the company's growing financial burden. Investors were clear. Stellantis hadn't solved a problem. It had merely swapped a political challenge in Canada for a financial crisis in the US. As the US continues to grapple with the ripple effects of its protectionist policies, Canada has turned what could have been a corporate retreat into a case study in economic resilience. Rather than reacting with panic, Ottawa treated the Stellantis situation as a proving ground for its broader industrial strategy, one focused on long-term stability instead of knee-jerk responses. Through a web of agreements covering electric vehicles, critical minerals, and logistics infrastructure, the Canadian government made it clear that multinationals could no longer pull out overnight without consequences. The message was simple: stability and structure matter. As a result, domestic investment returned with confidence. Over 1.2 billion Canadian dollars flowed into the Windsor-Essex region alone, strengthening local parts manufacturers and supply chains. Ontario's unemployment rate remained stable, hovering between 5.6% and 6%, even as auto parts exports to Europe surged by 18% in the third quarter of 2025. Internationally, Canada is carving out a new reputation as a reliable anchor amid North America's growing trade uncertainty, a place governed by consistent rules, largely untouched by political volatility. While the US struggles with the fallout of its own protectionist measures, Canada is establishing itself as the continent's electric vehicle hub, showing that a calm, consistent policy approach can be a powerful strategic advantage. The Stellantis situation exposed a key paradox in today's manufacturing landscape. Relocating production is no longer a solution, but a litmus test of national resilience. What once looked like an easy way around tariffs now serves as a cautionary tale about the real cost of instability. Each time a company relocates to avoid policy risk, it may gain short-term relief, but often at the expense of long-term security, fracturing supply chains and undermining trust. Canada's strength lies in its transparent regulatory system and adaptable governance. While the US finds itself caught between rising operational costs and unpredictable politics, reshoring production may continue, but profits are far from assured. Increasingly, global companies are re-evaluating their strategies, turning their attention toward more stable regions like Canada, Mexico, or the European Union, where predictability still holds value. Many analysts now warn that if Washington continues down the path of aggressive tariffs and economic nationalism, the very shape of North America's industrial landscape could be redrawn. And when that happens, the advantage will likely shift to countries that value stability over spectacle. This raises a bigger question in today's world of economic nationalism. Where does real power lie? With governments that pass the laws, or with the global supply chains that now shape the consequences? In the end, the Stellantis story is about much more than cars and tariffs. It's about how nations choose to define control in a world where borders no longer guarantee value, and where resilience may be the last real competitive edge that remains. Please subscribe to the Timefold channel, and don't forget to like.